let's jump right in. Welcome to The Explainer. I am absolutely thrilled you're hanging out with us today because, well, we're tackling what I like to call the final boss of personal finance. Think of me as your financial mentor as we walk through this whole thing together. And look, whether you're a young professional just opening up your very first portfolio, congratulations by the way, or you're someone nearing the end of your career and navigating the transition into retirement, this is exactly where you need to be. We're going to look at the freedom system and how you actually transition from simply having a bunch of money to creating true, sustainable income. Okay, so picture this. You've spent years investing consistently, right? You've watched market crashes come and go, you've seen recessions totally dominate the news, and you've watched fear grip the average investor. But you stayed patient, and over time your investments slowly grew into something incredibly meaningful. But here's the harsh reality. Building wealth, that is literally only half the journey. Getting to the top is a massive achievement for sure, but now you're facing a completely different and honestly often overlooked challenge. The mechanics of what you do next require a totally new way of thinking.
So let's dive into this, because this is that existential pivot that every single successful investor eventually faces. For the first time in your life, your portfolio has gotten large enough to actually support your lifestyle. And wow, that is an amazing feeling. But naturally, this massive question hits you like a ton of bricks. What do I do now? The theoretical game of investing is officially over, and it's just become deeply, deeply personal. Your money finally has a job, and that job is supporting your actual life.
Actually, think of your financial journey like climbing a massive mountain. When you're a young professional just starting out, you are laser-focused on accumulation. You're consistently adding money, you're building assets, and you are actively climbing up that mountain. But eventually, the whole process reverses. To get back down safely and actually enjoy the view, you need a totally different skill set. You have to shift to using wealth, which is all about sustainability and carefully, meticulously withdrawing money. Because the tools that got you up the mountain, they are not the same tools you need to live safely on the way down.
So, what's the very first thing most people think to do when they finally reach the top? They ask themselves, should I just sell everything right now and move it into a massive savings account? I mean, it feels like the safest move, doesn't it? Just cash out the whole shebang and sit on a giant pile of bank money. But I really have to warn you, doing that introduces a hidden, totally silent danger that can completely unravel decades of your hard work.
The strict mathematical reality here is that you can't just hide your money under a mattress. We have to talk about the elephant in the room, inflation. Over time, the cost of living just relentlessly rises. Housing, healthcare, food, insurance, literally everything becomes more expensive as the decades roll on. If your money is just sitting perfectly still in a bank account, it is slowly, day by day, losing its purchasing power. So to combat those rising costs of living, your money still needs to grow even while you are actively spending it. And this brilliantly illustrates the ultimate solution to that inflation problem. It's called a systematic withdrawal plan, or SWP for short. This is exactly how you preserve your capital while still paying for your life. A withdrawal strategy simply means creating a highly structured way to take income from your portfolio while simultaneously keeping the vast majority of your investments actively working for you in the background. Remember, the goal isn't just to have a giant pile of wealth. The goal is to create sustainable, mathematically sound financial freedom that supports your long-term lifestyle goals.
Let's break down the actual nuts and bolts of how this portfolio income works, especially if you're building your very first portfolio and you want to know what the end game actually looks like. Step 1. You keep the majority of your assets invested in the market. Step 2. Keeping those assets invested allows your portfolio to capture long-term market growth, which perfectly combats that inflation we just talked about. And Step 3. You balance this by only withdrawing a very small percentage annually to cover your living expenses. It's this beautiful, delicate balance that ensures your money lasts for decades. You aren't cashing out, you are simply skimming the growth off the top.
Now, I want to slow down for just a second because I need to put my mentor hat back on and give you a very serious warning. The absolute fastest way to destroy long-term wealth is withdrawing too much, too quickly. Patient, conservative withdrawals allow your wealth to survive for decades, but aggressive spending, especially during those unpredictable, painful market years, will shrink your portfolio incredibly fast. We see common emotional errors all the time that lead to this: panic selling during a sudden dip, instantly inflating your lifestyle costs way too much, or just straight up abandoning your strategy out of fear. Those are the exact mistakes that turn a lifelong fortune into a very temporary one.
The absolute greatest asset you have as an investor isn't your stock picks. It's your patience. And guess what? That patience still matters, even after you become financially successful. I tell clients all the time as they transition into retirement, true financial freedom is not about spending without limits or buying private jets. It is all about creating and sustaining a system. You absolutely have to maintain the exact same discipline that built your wealth in order to protect your wealth.
But when you do get this right, the psychological benefits are absolutely life-changing. It's not just about the math anymore. It's about waking up with profound peace of mind. You have less stress, less fear, way more control over your time, and the ultimate freedom to just focus on living your life. To maintain this kind of emotional stability during wild market swings, you really just need a simple mental checklist. Ready? 1. Trust the math of your long-term strategy. 2. Keep a comfortable cash buffer so you literally never have to sell stocks at a loss just to buy groceries. And 3. Completely ignore the daily financial headlines that are basically designed to make you panic.
Grasping this concept permanently shifts you away from short-term trading habits and completely rewires your emotional relationship with money. You adopt what we call the long-term ownership mindset. You stop seeing the stock market as a casino, you stop chasing those fleeting short-term wins, and you focus on building wealth quietly over time. And to build that long-term investment discipline, there are 3 simple routines you can start doing today to track your progress without obsessively checking prices. First, automate your investments so you don't have to make constant choices. Second, review your portfolio goals quarterly, not daily. And third, focus on the number of shares you own rather than stressing over their daily price fluctuations.
So the crucial point I want you to take away from our time together today is this. True wealth is built quietly through discipline, consistency, and time. Whether you are in the phase of accumulating wealth or you're making that massive transition into living off of it, these core principles absolutely do not change. By shifting your mentality to that of a long-term owner, you protect yourself from the hype, you protect yourself from the panic, and you ensure your money actually outlasts you. But of course, knowing how this whole system works brings us to the biggest, most practical question of all. Which ETF should you actually choose to build this freedom system? You now know that sustainable wealth requires a balance of growth and patient withdrawals, but do you execute that with the S&P 500, total market ETFs, dividend, or growth funds? It can feel completely overwhelming. But don't sweat it, because in our next explainer, we are going to break down the exact differences between these funds so you know exactly what to put in your portfolio. You really won't want to miss it.